Good afternoon. It's a pleasure to be here immediately after, I think, a power-packed session on the venture capital side of the story. I'm going to take it a bit ahead from VC. So just by quick show of hands, how many of you in this room are founders or aspiring founders? Okay. Great. So let me just take you through some of the stuff. Just a quick background. I've been in banking for almost 2 decades. Now I work with a bunch of private equity companies, consulting companies as a part of a firm that I run called Venture Studios. Also run a growth accelerator, and I serve on board of a couple of financial institutions. So I get to see it from the vantage of how the boards and institutions are looking at it when they make investments, to how the large flow of capital either coming from family offices or private equity looks at it. And of course, seeing it from the lens of a founder who are at early stage. So I think if you look at where we are today, I think there are 2 quick things. The founding 2025, we see that the funding there has a rebound. Of course, after a bit of a calibration and slowdown, money is finding, but big ticket chasing very, very fewer companies. So I think that is a big shift we see here, because the capital pools are very choosy about what kind of categories companies do they want to participate in. I think also there is a big shift in, rather than looking at growth at any cost, to see that how do you build businesses which has a durable unit economics, and thereby with adequate risk it can stand the test of time. I think the other thing, we all keep reading about it, but I'll tell you a bit about the story behind these numbers. We do know there is the UPI juggernaut in India continues to keep cranking, be it in terms of transaction value or number of transactions. If you look at some of this, maybe we have now started to take some of these numbers for granted. But I think in most markets, like I say, scale is a slide, but in India it's just a monthly number. And at times the power of scale is something living in India we just ignore. But I think importantly, it's creating opportunities for financial institutions to look at the lens of distribution, data, compliance, and thereby how do you create a set of partner ecosystem through whom you can accelerate and grow. I think when you look at the capital quadrants, of course, there are various pools of capital available. I'm not going to deep dive into some of the stuff that we all heard earlier, which is your either angel, early believers, to probably venture capital, or even private equity. I'll rather focus a bit more on strategic capital, because it's not about just access to capital, but it's also about what kind of business model you have, and thereby will that business be relevant for strategic investment or strategic capital. A lot of times founders come to me and then later on they say, we want to reach out to certain corporates to raise funds because they are also our customers. Can some of them become our investors too? The question always is, are you designing and building your business in a manner where it's appealing to the strategic investors who come in? So typically the institutional and strategy is where I'm going to spend a lot more time, because I think in today's market it's more about how ready are you for a certain kind of capital, because if you end up raising your capital from the wrong quadrant, then you end up having a lot of value resets and downtrends. So I think it's important to see where do you want to raise your capital from at a very, very early stage, and not just that the capital, let it come from wherever and we'll figure out later. Because I think a wrong quadrant, a wrong source of capital has a huge impact on the value reset. I think we all understand and know enough about venture capital, because you heard the previous set of speakers. They typically still bet on founder, they bet on ideas, they bet on founder's ability to scale up and create some magic. Because getting the speed and at which these companies can take is critical. But moment you start looking at institutional capital or growth capital and strategic capital, I think the question itself is very different. And I think the questions today, a strategic capital that is coming from, say, financial institution or clients, they ask, how does this plug in into my ecosystem? So if you're not building something that can plug it into their ecosystem, it's not something that's relevant for strategic capital. Today, for example, banks like HDFC, ICICI, IIFL, many of them, they increasingly, even in India, have started to invest. And the reason they go and invest is because they see that as core to their strategic business. Similarly, I think the growth and institutional capital, they do not want to take risks. So unless they understand how will you defend these businesses in adversity, how are you managing your compliance and risk matrix better? It's not just about great idea or a great founder, but it's also about the great team. How stable is that cohort? Because VCs, as I said in one line, they back ambitions, but institutions, they back survival. They don't want mortality. But I think the strategic capital always looks at how will you integrate it into their ecosystem. I think why strategic capital is gaining power is because increasingly in India, just like we see it in West, where likes of JP Morgan and Bank of America and many large capital one, they've gone and invested into many startups, or they have rather even acquired many of these companies and integrated. I think in India, banks and NBFCs both, and some in fact even wealth tech companies, are realizing that they just can't go and build a lot of things. The time to market and their ability to build is just not there. And increasingly, they are looking at how do they reduce their overall risk of building certain things which may not scale up. So rather than going and building in-house, can you look at investing into some of these companies and then look at how do you increase your overall, the margins, retention rates, also protect your downside. At the same time, provide them the governance and the regulatory safety. So I think they see this as more as a synergistic marriage between the two. And when you look at what are they testing, so I think this is another question people come and ask me several times, that if I go to certain kind of capital pool, which is unlike VC, unlike angel, what would they look at it? I think these are some of the key insights that, things that they look at it is how will you deal with business when your margins are under stress. The margins can be under stress because of competition, it can be around product substitution, it can be just that the market conditions will tighten, access to capital may not be freely available, there will be the downside on the valuation. So how are you managing under different stress condition your business? I think the second thing is on the cost discipline itself. How are you managing your unit economics? Because these are the set of investors, they don't back a founder and a founder with a lot of X factor to say we will do this and we'll do that. I think they are more clear about what are the cohort insights, what is the customer stickiness, what is the customer repeatability, how scalable are the operations. Like for example, what are your retention rates? What percentage of your customers are coming back again and again? What is your cost of acquisition resilience? Because what happens if your low cost acquisition channel or free to acquire initial customers, they dry up? How will you continue to acquire more customers? How are you building the next set of products to keep increasing your contribution margins? Concentration risk, again, extremely important because if you are getting a large share of your revenue from your top 3 or 4 customers, what happens if those customers churn or attrite? So I think one of the things is while UPI has given us all scale, everyone is saying that at the back of the data, payment, transaction, customer engagement, how are we leveraging some of those into creating the new business models, which can be around either embedded finance, wealth, risk management. And so I think when they ask you for these questions as to scale, what do they really mean by scale? Uh, I think scale, when they are asking about what's your unit economics quality, for example, they look at what are your real costs after all your uh, input costs, your collections, your delinquencies, your net losses. So unless you are able to look at your unit economics to the T, uh, you will not be seen as someone who has really got your business models right. Similarly, how well do you understand risk? Now, I know that risk is something most startups in India started to take it seriously only after they realized their business itself may not be around because of regulatory interventions and changes. But how well are you managing all your risks? So depending on the business you are in, for example, if you are in payments, I mean, what are your chargeback risk? What are your kind of fraud losses? How are you managing your disputes and settlements on payment? Similarly, on wealth, in terms of customer level persistency, accuracy of your models, customer cohort retention, some of the regulations around SEBI, which keeps bringing changes in your RIA model. So are you managing around concentration? I think we already spoke. Managing that becomes extremely important for any institutional capital, and of course, operating maturity. Looking at synergy, and this is what is the core to finding any institutional capital or strategic capital. I think the important thing to always look at it is the synergy has to have an impact on someone else's P&L. If synergy is not changing the P&L of the company that's going to invest in, then it's not a synergy. It's more of a story, but it's not a synergy. So I think going back and looking at your products or solution, does it significantly impact or changes the distribution advantage of the target company? Can they sell more? Can it reduce their cost of acquisition? Can it lead to higher conversion? So I think once you start understanding what are the metrics of the companies or what are their key challenges, and then start plotting. Similarly, the kind of data and access that you have because of the business that you run, can that data overlay along with the data that the company has helped them either build a better credit model, collection model, early warning system, forecasting and delinquencies. So depending on the area that you operate in, how will that create a strategic asset for the end company? Similarly, I think the technology cost and cost advantage, because we all know that when we are talking to these entities, banks or NBFCs, I think one of the things they all are struggling with is how do you reduce my cost of operations, change my cycles of innovation, how do I optimize a lot more on top of my legacy system? So can solutions that you are building, especially if it's targeted on a B2B or if it's a tech first, will this help reduce the overall technology and operation cost significantly? Don't talk about how cool is your tech. So often I find founders are so enamored by talking about their product and tech, but they do not talk about what it does for you. I think everybody has to translate that into the value, and values are typically in these dimensions. Does it help you get more customers? Does it reduce your cost of acquisition? Does it reduce your cost of technology? Does it make your whole resiliency better? I think it has to have a quantifiable value if you are going to make an impact. And I think important is also about who controls once you work with them. I also know many companies, when they started to work with one large financial institution and their investment, all of a sudden many other financial institutions were not very keen to work with them. So I think how do you make sure that you retain your independence while you are raising capital and you are not seen as, okay, these guys have been funded by Bajaj or by ICICI, so we won't touch them. So I think building that kind of control and clarity is extremely important as you are building it, because At the end of it, while you need capital and you need clients, but you also need open access to the ecosystem. And at times, if these become restrictive, then that itself is a big disadvantage. I think the last, when you are looking at raising, I think I'll go back to a traditional model because that has become even more important today than what it was earlier. That if you are a startup of any stage, how are you managing your risk? Each of the risk is real. And if you do not have accomplished risk professionals, either within the firm or advising you or on your board, you are likely to make some mistakes and that can cost you a lot more. So I think depending on area, your weightages can change. But for example, how are you managing your whole data privacy and the compliance around the DPDP regulation now? Because if you are handling data, you are managing data, how are you ensuring that you are not pulled up for not managing, or you may have some cyber security risk because you have some data leakage now because of you haven't put adequate controls while you have gone on public cloud. So I think how are you managing your risk framework? This is not only for banks, NBFCs and insurance. I think it's extremely important for every single firm, and I urge that if you are looking at not just raising capital but building business with long-term vision, build it as your day zero DNA in the firm. Because I think this also becomes in many ways, it can become your moat, and if you don't manage it well, it can be your obituary. So I think finding this as the core of your construct. This is just a quick closing. When you are going and talking to investors, I think there are a couple of statements that you keep hearing often, but what does it really mean? Because I think most pitch going forward will be more of a dashboard and not a deck. Because if you have real numbers, those numbers will show up in dashboard. If you have a story, story will be on a deck. So when you are talking about that we are able to retain our cohorts and we are expanding, then they will look at what are your cohort retention curves, what is the repeat purchase pattern, cross-sell, engagement matrix. So that is all hard data. Similarly, when you are talking about that our margins are improving as we are scaling up, again, that's a core data to show that, is your operating cost coming down with every unit economics or the value, or your contribution margins are expanding because you have ability now to charge customer higher because there is an engaged customer or there is a retention. Similarly, when you are talking about that we pass risk and compliance threshold, I think you just cannot make a statement. You have to demonstrate what are the regulatory approvals required, how are you getting your system audits done, how are you ensuring that you have your periodic compliance and checks in place, who are doing these audits for you. This is for building credibility. And I think the last is when we talk about going and pitching to say we do create a measurable synergy. Then I think we spoke about on the previous slide that you have to convert this into what are the distribution advantages, whether it reduces the CAC, what is the technology synergy. If you are able to quantify each of these backed with number and evidence, I think you have a credible pitch for strategic investors to be interested in. To close it, I think key messages. One, I think the India story will continue to grow, largely because of the whole infrastructure. If you can play, build or participate in the business that is getting built on top of scalable infrastructure with the kind of controls which are more institutional grade, I think then you are in for leveraging each of those opportunities that are coming today in India. And this is not just around payment railroads. There are people building on top of GST, they are building MSME credit and underwriting. There are solutions that's being built on the wealth advisory. Every single space that you look at it, I think the data is opening multiple railroad opportunity. Second is I think the funding exists, like I told in the beginning. but it's concentrated. So I think funding is not easy, but if you are able to build your model right, you can raise a much larger round provided you get some of these things in place. And I think compliance is not a task or an ask, but it's integrated part of the business. So if you are integrating that up, and I think these stories and scale will continue to accelerate, but important is for you to build the firm day zero with resiliency and foresightedness. So I'll conclude this with all. Thank you. If I know the time is up, but if there's any one question, can I take? If someone has one? Yeah. Happy to take one question if anyone has one.
Yeah, in B2C segment and especially fintech, what we see is exponential valuations for fintechs who have been in the industry for let's say 10 years and all, burning money though growing the sales, and trend kind of continues, right? So what is the thought process behind it? And in this, because of this, lot of promoters now are in the mind like burn the money, give unrealistic discounts and just grow. We will think about the profitability, and for 15 years if it is not profitable, I fail to understand like.
No, that's true, and that's why you realize how many companies have gone down under now, because like there's a famous saying, right, till the time you can keep dancing till when the music is on, and then what happens when the music stops. So precisely I think you can burn, but as long as you cannot demonstrate your path to profitability or unit economics right, and a lot of these, that's why I said is not a PPT, these are all hard numbers. If you can show that your cohorts are becoming profitable or gradually your cost of acquisition is coming down, maybe yes, it may take little longer and investors would be patient to support that. But I think if you are not able to make these metrics demonstrate quarter on quarter, for example, the classic story was of Eternal or Dipinder Zomato, right, where he said that even after going public, he does not give a very long-term vision even as a public company to his investors. But at the same time, he does say what are the cohorts, trends, numbers they are looking at. So you are fine. I mean, you can be on that quadrant, but then you have to deliver your execution ability that in your investors are going to test and see. If you lack credibility in what you promise, I don't think you will be around for 10 years or probably not even few years.
So in terms of investor mindset,
I think we can take the question offline. I'll just close it with this. One, you want to? Okay, thank you.
That was a wonderful session. Thank you, Mr. Deepak Sharma, for sharing those insightful perspectives